What if you could earn $100 a month in passive income without working more hours or starting a side hustle? Sounds too good to be true? It's not. Because today, we're diving into two dividend-paying giants, SCHD and YMAX, to uncover which one could realistically put a crisp $100 bill into your pocket each and every month faster. Now, here's the kicker. One of these ETFs might be rewarding investors handsomely right now, but could be silently burning your portfolio long-term. And the other? Well, it may look boring on the surface, but under the hood, it's a dividend machine with a track record of stability and growth. So if you're serious about building income without sacrificing your long-term gains, this isn't a video you want to skip. Most investors think high yield equals high income. But here's the first trap: chasing yield without understanding the structure. YMAX has been turning heads lately with yields soaring above 15%. Yeah, you heard that right. But why is no one talking about the trade-off behind those numbers? Because high yields often come at a cost, and it's not always obvious until it's too late. Meanwhile, SCHD's more conservative yield, typically hovering around 3.5% to 4%, might seem underwhelming in comparison until you look at how it's been quietly compounding and growing its payouts year over year, backed by some of the most reliable dividend-paying companies in America. Let's unpack the foundation. SCHD tracks the Dow Jones U.S. Dividend 100 Index. Translation: it focuses on high-quality companies with consistent dividend payouts and solid fundamentals. Think giants like PepsiCo, Verizon, and Coca-Cola. These are names that have weathered economic storms and still delivered checks to shareholders. Its expense ratio is just 0.06%, extremely low, which means more money stays in your pocket. On the other hand, YMAX follows a covered call strategy on the NASDAQ 100 through a partnership with Global X. It's an income-generating machine by design, but it sacrifices growth for cash flow. And the expense ratio? A heftier 0.6%, that's 10 times SCHD's cost. So what does this mean in real-world results? Let's say you invest $30,000 in each ETF. SCHD, with its yield around 3.8%, might bring in about $95 a month steady. Reliable, and with room to grow. But YMAX, currently yielding upwards of 15%, could generate over $370 monthly. Sounds like a no-brainer, right? But not so fast. That $370 isn't guaranteed to last. Because that sky-high yield? It's partially fueled by options premiums, which fluctuate and can diminish over time, especially during market downturns. And the biggest catch, YMAX's share price often declines, which means you're potentially losing capital even as you pocket dividends. Here's where things get interesting. SCHD has averaged around 11% total returns annually over the past decade when you factor in dividends and growth. YMAX is newer and lacks long-term data, but initial signs suggest it struggles to preserve capital. If your goal is $100 per month, YMAX gets you there quicker, but with far more risk. You're potentially eating into your principal just to fund that income. In contrast, SCHD might take longer to reach the $100 milestone, but it builds wealth as it pays you, giving you both income and compounding power. Let's throw a curveball in here. What if you reinvested dividends from SCHD every month instead of spending them? That slower $95 per month could snowball into $110, then $125, and eventually beyond $200 per month as the portfolio grows. Compounding turns steady into powerful. YMAX, due to its income-first structure, lacks that compounding benefit. Most of its returns come in cash, so if you're not actively reinvesting or if its share price is dropping, your income stream stays flat, or worse, shrinks. And now, let's address the elephant in the room: taxes. SCHD's qualified dividends are taxed at a lower rate for most investors. YMAX's income includes options premiums, which can be taxed at higher ordinary income rates. So while that 15% yield looks sweet on paper, Uncle Sam could take a bigger bite than you expect, meaning your actual take-home income might not be as impressive as the headlines suggest. This is where many investors get blindsided. They see yield, ignore taxes, and wake up during tax season wondering why their refund disappeared. Now let's go deep. Imagine the market enters a correction. The Nasdaq drops 20%. What happens? SCHD's price will likely dip, yes. But its dividend is supported by cash-generating companies it's sticky. YMAX, however, will likely take a double hit. The underlying stocks decline, and the premiums from covered calls shrink as volatility dries up. Suddenly, that juicy $370 per month could drop to $200 or even less. This is where income investors panic. The yield chasers bail. But the ones holding SCHD? They stay calm, reinvest, and prepare for the rebound. Here's the thrilling twist. Investors who build with SCHD can eventually use its income to buy into riskier assets later, on their own terms. You let the snowball build safely first. It's the tortoise and the hare all over again. And sure, the hare might win the first mile, but ask yourself this: where will you be in year 10? Which ETF will be giving you not just $100 a month, but $200, $300, even $500, all while growing the original investment? That's the quiet power of SCHD that most overlook. So here's the million-dollar question. Do you want fast income now, even if it means burning your capital along the way? Or do you want a system that grows your wealth and pays you for life? Most won't think that far. But the smartest investors? They're playing the long game. And now that you know the real difference, it's time to act with intention. Whether you go with SCHD, YMAX, or a combination of both, the key is understanding what you're actually buying and why. If you've made it this far, you're already ahead of 90% of investors who pick ETFs based on flashy yields and trending tickers. You now know the strategy, the trade-offs, and the hidden costs. You've seen behind the curtain. So don't just scroll away. Take a minute to reflect on your financial goals and ask yourself, is your portfolio built to survive and thrive? Or are you one market dip away from watching your income stream evaporate? This is the kind of insight that could literally change your financial future. And if you found value here, hit that subscribe button. Drop a comment telling us which ETF you prefer and why. We've got more deep dives coming, including one on JEPI versus QYLD. You don't want to miss it. Thanks for watching. As we've explored the Schwab US Dividend Equity ETF, SCHD, and the YieldMax Universe Fund of Option Income ETFs, YMAX, present contrasting approaches to dividend investing. SCHD offers a moderate yield of approximately 3.35%, with a commendable 5-year dividend growth rate of 9.04%, reflecting its focus on high-quality, dividend-paying companies with consistent payouts. In contrast, YMAX boasts a substantial yield of 34.82%, primarily generated through an options-based income strategy. However, it's crucial to consider the sustainability and tax implications of these yields. SCHD's dividends are primarily qualified, potentially offering favorable tax treatment, while YMAX's income, derived from options premiums, may be taxed at higher ordinary income rates. Additionally, YMAX's strategy may limit capital appreciation potential and expose investors to higher volatility. In conclusion, if your objective is to achieve a steady and potentially growing income stream with an emphasis on long-term capital preservation, SCHD appears to be the more prudent choice. Its consistent dividend growth and lower expense ratio align well with a strategy focused on sustainable income and wealth accumulation. Conversely, if you're seeking higher immediate income and are willing to accept the associated risks, including potential capital erosion and higher tax liabilities, YMAX could be considered. However, It's essential to thoroughly assess your risk tolerance and investment goals before proceeding. Remember, in the realm of investing, higher yields often come with higher risks. It's imperative to look beyond the surface and understand the underlying strategies and implications of each investment. Make informed decisions that align with your financial objectives and risk appetite.